Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Hey everybody, welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm a managing director and partner here at One Capital Management. This show, the Make Your Money Matter show, is dedicated to helping you create a better relationship with your money because after all, your money matters. And I say this, the word relationship with your money, because I think today we all realize that the access to information is really not that hard to find. You can Google something, you can read something, listen to something, but understanding the truth behind the information you receive matters. And I share that today because we've had a lot of information that has been going on in the past few weeks. A lot of news happening over this and that, politically, economically, really over this entire year. And I've spoken recently about this, about investing and taxes and the volatility on previous episodes here on the Make Your Money Matter show. And I want to pick up on that a little bit and go through some news that's come through that I think everyone's thinking about. I know we've talked to a lot of clients on this, and I want to share that on the shows I do each and every week, and what really in the world is going on with the markets. A few weeks ago, we technically hit a bear market. And I say technically because depending on what you look at, typically when the market goes down by 20%, we've entered bear territory. And I've talked a lot about this in our review meetings with clients here at One Capital. And many of you listening on the show here, we've actually gone through these conversations about keywords that everyone's eyeing in on, right? Inflation, supply chains, and all of the vernacular that you've heard here this entire year. But I want to go in depth on some of these things and share what I believe is really going on and what I think I want all of our listeners and our clients to truly understand. I'm going to forewarn you about something. I might get a little passionate today. Now, before we dive in, be sure to smash that subscribe button and hit the notification bell so you don't miss a single episode here of the Make Your Money Matter show. Now let's get into it. My 4-year-old daughter, Kate, actually she's 4.5. She tells me every day. Her birthday here is in a couple months and she's very open about the 4.5. Anyone with kids or grandkids knows this, I'm sure. We played card games. That's something her and I do. We do it every day for at least a couple hours. And we play everything from memory games to a new game she loves right now called Shark, Alien, Zombies, which is basically a new card game that's a cross between rock, paper, scissors and the game War. So, you know, being an 80s baby, I kind of love that. But she has this saying whenever we play games or any sports or anything we do, and it's really been a saying for the past year. Every time she wins, and I let her win often, every time she looks at me and she wins, she looks me dead in the face and she goes, "You lose, I win." And it's not that it's "I win, daddy," or anything like that. She literally says the term this way: "You lose, I win." And I want to talk about that right now because I had an epiphany the other night when we were playing a game, and again, I lost and she won. And it's actually pretty profound when you think about it as it relates to what I talk about here with our clients and on this show, as it relates to the economy and politics and really everything we're dealing with right now. This week's episode, as I mentioned a few minutes ago, will be a little bit different because I want to speak plainly. And like I said, I may get passionate here. And my daughter Kate's saying of "you lose, I win," I think to a lot of us Americans sounded like some of the speeches from our administration and some political leaders and how they've sounded lately. Don't you agree? And by the way, this is not a political show, nor will it ever be. But many times, and I say this because the market and what comes out of Washington, D.C. are different. I know emotionally the news outlets, they like to confirm our biases and one way or the other, whether it's through social media or with our friends or colleagues, we are able to confirm or reaffirm our own biases. And those have those places, but not here. But the reality is the market and what comes out of D.C. are very different. They are not combined. Yes, there's regulation between different administrations that are involved. Yes, there's things we have to consider, and we do that as portfolio managers, as investment managers for our clients and for our portfolios. But I just couldn't help recently and think of my daughter Kate when she tells me all the time in our card games, "You lose, I win." A few weeks ago, our administration came out and essentially said that and had the audacity, I should say, to basically say that we are an economy that is thriving and doing better and doing great, better than it's been in a long time. And I think for me, and I hope I can share this in this format, it was just a reminder that our politicians in Washington have sometimes zero relevance to what's going on for many Americans. And really, I don't care what socioeconomic scale you are on, we feel paying for that carton of milk is more expensive, as we know now, than it was a year ago. Let me give you an example. Right now, I'm having my truck shipped from somewhere, and it's been actually stuck in the port of San Diego. We live in the Los Angeles area. So not even in San Pedro or Long Beach or Los Angeles, in San Diego. I spoke with the shipper recently, and they're basically telling me it's a trucking issue. We don't have truckers to ship it up, to which I said, okay, well, it's been there for almost a month. I'll go down to San Diego and get it. Well, Brad, that doesn't work either. And obviously I'm dumbfounded. I'm like, well, why? Well, we have to move it from the port to the pickup location in San Diego, and we don't have enough manpower to even move it up from the port to the pickup location. We're gonna talk about this today on some data points I wanna bring up when it comes to wages and employment. But, this just reminded me again, it's ironic to me that our administration a couple weeks ago was at the port of Los Angeles saying things like our economy is doing well, it's better than before. And it's just unreal sometimes of what we're seeing. And I don't mean to, lament on that. I just wanted to share that. I was feeling it like many Americans were, like many of my clients were recently. And by the way, that's bipartisan. That's on both sides of the aisle. That's not a Republican thing or a Democratic thing. Again, this is not a political discussion. And I want to shift here for a second because this is some news that has come out that I think really shook up a couple people, and I want to talk about it. There was a CEO, Jamie Dimon of JP Morgan. He caused a stir when he talked about a quote, unquote, hurricane hitting the US economy. And I've been sharing this with clients on our radio programs, on our podcast, and I want to share it here on the Make Your Money Matter show. Look, like many other bank CEOs or consumer staple company CEOs or economists, he might be right, because I don't think anyone's surprised of what's happened over the past 2 years. Is he saying it's going to happen right now? I would defer on that. I mean, really think about it for a second. Regardless of your knowledge of where or your whereabouts, really, or what you know about maybe an M1 or M2 money supply or any of this economic data or any monetary policy theory, that's our job. We take care of that for our clients. But I think all of us can truly, if we're really honest with ourselves, we're not surprised if we shut down the world, literally, for like nearly 2 years. And by the way, isn't it weird that we kind of got used to it? I mean, you look at those things and naturally GDP, gross domestic production numbers fell, and we also were printing money. There are certain areas in an economy that didn't do that bad, right? We know that restaurants, hospitalities, obviously the travel industry, that got hit really hard, but things like technology, companies like Amazon, purchases and consumer goods, those increased. So all of it had its place, but when you shut down the world and actually print money, basically you're gonna have inflation. Like that's the exact recipe. So what's going on right now is not shocking to anybody. And I think a large part of this is reaction to the market. And what we need to make sure and remind yourselves, and I tell this to clients, and I know for those of you watching the show, you're gonna hear this, it's probably till I'm blue in the face, discipline and discernment wins out. The best part, I will say this, about what's going on right now in our inflationary environment is we have tools. And I say we proverbially as a country. We have the tools to fight this. We have great monetary policy. I actually have confidence in Powell, what we're seeing there. Because remember, he was dealt this card for the most part and dealing with what we have to deal with. And I want to talk about a couple data points that I think are really important for us to take in consideration when we look at all this news that's going on there and able to, disseminate the information for ourselves. The employment report is something we look at, and it's good to know this. The employment report for May, which is just a month ago, confirmed that the US economy is actually continuing to grow. And here's what I mean by that. Both major measures of jobs went up in May. Non-farm payrolls rose by 390,000, while civilian employment increased by 321,000. Now, here's what's interesting. Total hours worked actually expanded as well by 0.3%. So the conversation of, has a recession already started? Well, if you look at those numbers, no. Now, notably, there is some evidence of a transition in the economy right now away from goods, as we saw during 2020 and 2021, and towards services. And that's what those data points were showing us. And we see that because retail payrolls are still up from where they were pre-pandemic, but dropped about 61,000 in May. So with the exception of the initial onset of lockdowns, starting in 2020, That's really the steepest drop for any month since 2009. 61,000, as I mentioned. So meanwhile, jobs, speaking of that real quickly, again, the leisure and hospitality industry increased 84,000, the 17th consecutive monthly gain. They've been massively hiring back to meet, I guess I should say, the demand of the post-pandemic opening up, if you will. All of these fits in with recent activity in the stock market. We've seen volatility. It was heavily launched January, February of this year with stuff going on internationally. But where companies that specialize in retail goods have suffered relative to those like theaters, airlines, hospitality, which provide services. So more people, essentially how we read that data, more people want to be out and about and getting back to normal. I think anyone watching this right now, we'd love that too, right? And that's what I'm trying to say here. We see the volatility as a portfolio manager, but it's not across the board as the news outlets want us to believe. Now, the worst part, I think, of the jobs report, and I want to bring this up, was for wages. And I think many of you watching right now, we've thought about this, how we're feeling this. The average hourly earnings rose by 0.3%. Now, in a normal economy, a 0.3% gain will be perfectly fine. But just to be clear, because consumer prices, which is where inflation comes in, consumer prices were up an estimated 0.7% again in May. That's no good for workers. By the way, any of you out there who've seen some of the readings or maybe are looking for a raise, if you go get a raise for 0.3%, which is basically what these numbers are saying, but everything else is outpacing you with gas prices and everything else combined to 0.7, did you really get a raise? I think we're all feeling that right now. And with the administration right now saying, that's why I come back to what my daughter said. They're basically saying, you lose, I win. They're saying that right now because everything's fine, but the reality is we got a lot to deal with. And frankly, in my opinion, and this is an opinion of an American citizen, not Brad Barrett, the host of Make Your Money Matter, this administration is not doing what I feel they should be doing. I think many Americans and many of my clients on both sides of the aisle believe that. And again, I'm not trying to get political. It's not with this show. And I told you in the onset of today's show, I was going to get a little passionate. I would say this, by the way, of any administration that wasn't doing certain things based on foreign policy or economic domestic policy here that benefits the average everyday American. So in a normal economy, again, 0.3% wage increase, perfectly fine. But with consumer prices up 0.7, it's not good for workers. So literally, we have our administration and his words, he's basically saying, you lose, I win. That's not good.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
The funny part is some politicians are trying to take credit for the job growth, namely our administration in particular. I mean, they basically said, and he created, quote unquote, 600,000 new manufacturing jobs, as an example. Now, it is true, that is nearly how much manufacturing jobs rose or are increased since January of 2021, basically a year and a half ago. But total manufacturing jobs are still 17,000 below the pre-pandemic peak. Context here. And I think one of the main things that I bring up these data points, again, not to bore you, but I want to start with the Make Your Money Matter show is to take what we intake, I should say, from colleagues, newspaper, news outlets, and put it into context as it relates to how you have a relationship with your money. Politicians, as we all know, want to take credit for the good and blame others for the bad. We know that. That's nothing new. That's on both parties. And we as fundamental advisors in our job with the market, as well as with geopolitical and political administrations and events around the world, we're forced to take data at face value with no political point of view. This is not a political rant by any means. And I promise you, there is no political point of view in this because we don't have the luxury of that. Our job as fiduciaries to our clients, and I've been managing assets for nearly 20 years for clients, and I've seen many different administrations, both Republican and Democrat. Everyone has their issues. Politics, as we know, is not perfect. The economy right now is still climbing, albeit slow. We have not opened up yet. We are still opening up. So we need to remember that we see things and we will see jobs grow, but in context, we have to understand how it's growing. We're seeing jobs grow in 2022 in spite of, believe it or not, the Fed raising rates. In spite of this problem, consumer cash flow and balance sheets, if you think about that, remain really healthy. And that's, again, context. Here's a stat that I think is really interesting to know. The financial obligations ratio, which finished in 2021, December 31st, was at 14%. Now, I want to bring some context to that. That's the share of us as consumers of our after-tax incomes that we need to use or pay on our debt obligations, things like mortgage payments, car loans, or just debt payments in general. So right now, if you think about it, your own situation, that number I mentioned to you is your own after-tax income specifically going towards debt payments. The average right now is at 14% for Americans across the board. Even though yours and mine might be higher or lower, the average at 14, I say this because that includes reoccurring payments such as property taxes, homeowners insurance, car lease payments. From 1980, which is when this data started, from 1980 to the end of 2019, the ratio was never lower than 14.7%. Let that sink in for a second. Many Americans I talk to, and I talk a lot about this with many clients, especially in our practice here at One Capital Management, clients say we have debt. That's a normal thing in life. Very rarely do I find no one doesn't have debt, good debt or bad debt. And this is not a discussion whether that's right or wrong. As you heard me say before, there is good debt and bad debt, but we know debt's a part of life sometimes. But to look at that stat for a second, when you think about consumers and the cash flow balance sheets, how they remain very healthy. And I've shared this. If you look at the M1, M2 money supply, which is basically the Federal Reserve's indicator of cash, there's a lot of cash sitting on the sidelines. And that's an important notion to remember as we look at investing in the future, because right now we are looking at volatility. We have headwinds, we know that. And we can get really myopic in our point of view because these days are long right now. When you see a bunch of red going on, you're looking at your portfolio, you're talking with your advisor, we're taking all these inflation numbers in and all these issues, and that's all true, but staying focused on the long term and seeing the bigger picture is what really matters. And I want to add something else to this stat here, the 14% debt obligations of an average family income. Household net worth finished last year at more than 8 times annual after-tax income. That's the highest ratio on record. Americans had across the board had $1.2 trillion in checkable deposits and currency before 2020. And at the year end, when they did this stat about 6 months ago, December 31st of 2021, they had 4.1 trillion. There's your stat, ladies and gentlemen. That's the understanding of how much cash is on hand. That doesn't mean you and I are holding a bunch of cash. And if you're watching or listening right now, it doesn't mean you're in the wrong by not holding cash, but we have to look at it from the broader economy. What is the economy? It's you and I. So the bottom line, in my opinion, is we've had a loose money policy from our Fed. And the loose money policy from the Federal Reserve has really inflated everything. When you print money, you're going to have too much money chasing too few of goods. That's the definition of inflation. My point earlier is we're not totally shocked in what we're seeing here. Did we not think there was going to be a tail whip on what we were doing by shutting down the world and having money come in without having production? And we're seeing that right now. Now, moreover, monetary policy still remains somewhat loose. They're tightening. I know that. I know we're raising Fed rates right now and it's becoming less loose. So let's put it that way. It's still less loose if you look at it, and it's a lag. I think between loose money and the economy is still long and somewhat variable. So to put it all together for a second, looking back to my comment from Jamie Dimon talking about, there might be a hurricane on the radar. And this is an opinion right now based on our firm and our research data. It's not as close as he might make it seem. And again, even if he is right, and he might be in the future, and the concept of recession, we have to understand and keep a bigger view and not get really myopic and lose our minds in these time periods of volatility. We have to keep the long vision here. And when we talk about recession, speaking of that, there's indicators all the time. One is an inverted yield. We talk about all the time. That's when short money becomes more attractive than long money. And now typically, if you go out in duration, long money, think of a CD as an example, you typically would say, okay, if I went out 3 years at the credit union for a CD, I'll get a higher interest rate than if I did one at 1 year. When you have an inverted yield, short-term rates become more attractive. And we see those blips happen all the time. And it's an indicator, one of many, of a recession. And that kicked up the dust, I think, earlier this year, with a quick blip on this. But long money is still more attractive currently than short money, which is a good thing in the economy. So the recession to us, might be on the horizon, but we're looking into it. We're managing portfolios around that, and we're just not seeing it happening tomorrow. I mentioned this to clients recently, and we talk about volatility. There were 2 economists in 1972. Their names were Robert Hogan and James Hines. And they actually went through a study and proved in their own data that higher risk doesn't necessarily mean higher reward. They concluded that over time, and I quote, stock portfolios with lesser volatility have experienced greater average returns than their riskier counterparts. And I mention this because we focus a lot on having balanced portfolios and having active management. And really what I call, when I talk to my military clients and my first responders, I call it protecting your six. It's when you protect your downside, protect what can harm you. So when you see markets right now going down 20%, heading towards bear or in bear territory, but average portfolios from an active manager are down maybe half of that, you look at that and you kind of go, and I mentioned this before, I had a client one time tell me you sucked less than most. I remember thinking that was like a really weird backhanded compliment, but it basically proved managing risk. And a good portfolio manager, anyone who's out there seeking advice and portfolio management, should really find a good risk manager, because we're in a volatile period this year. We are down in the markets. You've seen that. And there's protection, and protecting against volatility and making sure that we control downside is of utmost importance. And you do that through diversification, through active management, rebalancing, all the things that a good portfolio manager will do for you. If you think about it, most people, you and I, we have the intelligence to make money investing. And let me give you an example. My 6-year-old Brooks, I do this sometimes with him, kind of joking around. I said, hey buddy, here's a list of mutual funds. He has no idea what they are. They're equities. I just give him a list of ticker symbols and we just go through it. No idea, right? I said, just pick one or two of them. In a year like 2021, as an example, my 6-year-old will likely make pretty good earnings. It's not rocket science, okay? The years of high market returns doesn't necessarily mean you're a good investor. So most people, we have the intelligence to make money investing, but many don't have the stomach. And I talk about this a lot, behavioral financial traits, and I share this because you hear me say consistently, we have two brains going on in our body at all times, the logical and the emotional. So we have the intelligence to make money and understand investing, but we don't have the stomach. You know, in 2008, the stock market crashed nearly 50% in a matter of 18 months, essentially. The next 2 years after that was up 86%. The next 6 years was 80%. Buying quality and staying disciplined matters, doesn't it? You know, we don't know what's going to happen tomorrow or the next year or the next 2 years, but we do know that if history tends to repeat itself, especially economically, historically data, we understand that we invest in quality companies, keep a disciplined, active managed approach, volatility can actually become a good friend of ours. All right, it's time to answer some of your questions. If you have a question or topic you'd like me to address, you can leave a comment or a question in the comment section below, or if something you want to go through more one-on-one, just go to the About page on this channel, send us an email. We'll always keep the questions anyone writes here or sends us anonymous, so you don't have to worry about your name being shared, but we'd love to hear from you. And one of the questions that came in is, should I keep investing during this volatility? And the sub-question to that really was, should I keep investing with potentially a recession looming? My simple answer is this on this show: yes. And I think what we are seeing right now, and a lot of my conversations I've had with our clients here at our firm at One Capital Management, and for many of you listening, is that we have to understand that the value of the market doesn't necessarily reflect the exact current economy. And here's what I mean by that. And you can see that now. It's rather the market, all of us, are trying to predict what is coming up soon. That's what we call consumer sentiment. And many traders right now are out there in the world trying to forecast when this said recession looms. You know, like we're seeing right now, the market tends to go down. But when the recession actually gets here, if you look at history, the market begins rising. So predicting the recovery is hard. And this forward-looking aspect of the market can be hard to wrap our heads around, which is why I understand this question fully. And when someone asks me this question, I get it a lot. Let's take an example. Let me give you an example. It's like talking about Tesla. It's a big name right now. Like, should I buy Tesla stock because more electric cars will probably be available and sold in the future? And you know, if you think about it, the answer is really kind of interesting. And this actually came from an article I saw on Personal Finance Club, and the guy was talking about it, and I liked it. It was interesting to answer this. The answer is, it's probably too late to use that knowledge, that specific knowledge, to your advantage, because as an example of Tesla, in that example, the stock may already have priced in the assumption of the electric car growth. And I think this is true if you think about it and you relate it to the economy. All of the information about the predictions is already, quote unquote, priced in. Unfortunately, for all of us, it's hard to predict the predictions. I mean, if we knew how these predictions would change next, then we could jump in and out of the market to avoid downturns, and we'd market time like the best of them. That's literally the definition of market timing. And you hear me say every week, right? It's not about timing the market, but time in the market for that exact reason. Now, unfortunately, we can't know any of that information until it becomes available to the world. And by then, it's too late. So what do we do? Now, here's fortunately the answer to expand on the simple answer I gave earlier. Ignore the nonsense. Ignore the noise. Keep investing in good times and in bad times. Keep discipline to your approach, whatever that might be. Now, obviously, that's not pure advice for everybody across the board, because we have to understand that you have to sit with counsel like we do here at One Capital Management and making sure that we specifically tailor plans for our clients. And again, the answer is simple. Yes, keep investing. It's in context of your plan for all of your debt obligations you might have, we spoke about earlier, your cash flow, and relative to your lifestyle. So really more than anything, when you hear the blanket answer of yes, obviously keep investing, keep disciplined. It's understanding that you have to make sure you also sit with counsel and a good advisor to help you objectively look through what is all going on here. And remember for yourself the two brains, logical and emotional, and make sure that the emotional brain isn't winning out. And I think it's good to end on a quote that I think actually just kind of came to me as we're talking about the subject matter and answering this. Warren Buffett once said, "Be fearful when people are greedy and greedy when people are fearful." Take a look in the market, understand your plan, stay disciplined. And again, if you have a question or comment you'd like me to read here, you can leave it in the comments section, or again, email us in the About page on our channel. And before we go, if you found anything helpful today and want to learn more, you can visit us on our website at onecapital.com. If you'd like to call us or text us, you're happy to do that as well. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value our relationships. It's the lifeblood of what we do. So click, call, or text us today. And if you're not following us on social media, you should be. We're sharing great information on all of our social media platforms. As I often say, if you enjoy the show, share it with someone you like. If you don't like the show, I guess share it with someone you don't like. But until next time, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.